Why is the homeowner age in our country for first-time buyers skyrocketing right now? So in this video, I'm going to get into the details. I got some notes in front of me, which is always good for you all, so I don't ramble too much. But first thing, I want to address this shirt. This shirt is loud. Obviously, supporting my Tennessee Vols, but wow, on camera, really loud. It doesn't feel that loud whenever I put it on, but now that I'm noticing, sheesh, so sorry about that. If you just keep paying attention to the shirt, I apologize. But let's get into some stats here. In 1991, the average age for a home buyer in the United States was about 28 years old. In 2021, so 30 years later, the average age for a first-time buyer, that's what I say, this is actually first-time buyers, not just, I may say homeowners, but every time I'm meaning first-time buyers. First-time buyers was 32 years old. So that's an increase in 30 years of just 4 years, right? So not much at all of an increase. Obviously, pricing and inflation and everything has gone up, so it probably would be naturally expected for that to happen. But only 4 years in the age gap for 30 years. Now, from 2021, which the average age was 32, to today and arguably 2025, the average age is now 40 years old for a first-time buyer. That is an increase of 8 years over the course of 4 years. So, I mean, just mathing it, right? If you're writing down some notes, that's a scary number. So why? What's going on? What is some reasons? Well, one thing that probably not a lot of people pay attention to, and it's not necessarily like super talked about in data and by maybe your influencers and people on social media is looking for clickbait stuff, but it really is these huge corporations are buying up single family homes, giant corporations. Now, they're not really flipping them. They're buying them and holding them. They are turning them into rentals. Here in Knoxville, I think it's called like Main Street or something. If you actually go on Zillow, you look for rentals, right? There's a company, it's Main Street, something Main. I should have looked at that video. But anyways, I mean, they're everywhere. And they're for sale or not for sale, but they're for rent for an outrageous amount. But I mean, you're talking just in like the little Knox County area. When I see those rental, I mean, they've got to have like 100 of them. So you're talking, and these are nice homes with your probably, sorry if somebody call me, your average price points, probably somewhere but around $350,000, $400,000. Like these are good homes and up to like $600,000 homes they're buying. So, doing some budget, let's just say the average one's 400,000, they got 100 of them. They got $40 million tied up because they're going to buy all this stuff cash. Which is wild. I've actually done listings and gotten offers directly from them. Usually they just an offer like the day of you listing. It's like almost like an AI automatic thing. And it's usually like 70% what the home is worth, something like that. Looking for a deal, desperate seller. They do that. Of course, BlackRock, right? The name everybody knows, right? Coming in and it's you're not going to see BlackRock buying a single family home. You're going to see like subsidiaries and companies under their umbrellas and companies under companies that they own. And who knows? Maybe that's the Main Street. Maybe that is a subsidiary of BlackRock. I don't know. But that is a big thing where they've bought all these single family homes to keep prices high. Also, here's what builders are also doing to keep prices high. Builders, instead of lowering the price and taking less money, they are offering buyer incentives. So they're offering free upgrades, tens of thousands of dollars. They're offering rate buy down, which is very important, and I'll get into next, is the interest rate. So they're offering these rate buy downs. I know in a place like Texas is where it's really popular right now. These builders are spending $30,000 to $40,000 to get your interest rate from, let's just say, perfect credit today at like 6.5 all the way down to like a 4.5. And so they're spending all this money, but what it does is it keeps closings, keeps comps, keeps all that stuff high. So it's basically offsetting to where you as a buyer, hey, your payment's $800 a month less. Great. And for the builder, right, they can keep prices high to keep it from coming down and kind of hurting the market. So the data is muddy. Same thing for kind of just how our general market is right now for sellers, right? Sellers are giving lots of closings and concessions, but the prices aren't necessarily coming way down. But let's get back to the first-time buyer conversation. That's just something I want to go off on a little tangent, as big businesses are now competing in this industry, whereas, again, 1991, they really weren't competing. And even really pre-COVID, they weren't doing it at the rate they are now. So prices really from 2019, and we're talking about here in East Tennessee specifically, but even nationally is pretty closest data. From 2019 really to the end of 2022, because that's when rates started going up, Every home's probably worth somewhere between 50 to 100% more plus, and that's doubled. I know homes that for sure have more than doubled since 2019 in our area. Now, if you still even bought in 2022 at kind of like the peak, your house is still probably worth another 10, 20% more than that, maybe even a little bit more in, again, certain niches and micro markets around our area. As prices continue to go up in kind of 23 and 24. And again, on paper, the median price is still going up. Again, that is muddy there. So I don't think it's necessarily exactly true that prices are going up, but they aren't just coming down at the rate as far as the purchase price goes. So let's take a look at the interest rates. So interest rates in, peak COVID got down to where if you are a buyer and you had perfect credit, you can get like a 2.5 interest rate. Well, they got all the way up to its peak around 8% interest rate here. So that's a giant difference. Now they're probably around 6 to 6.5, depending on your credit score and your loan type. So rates arguably are down to the lowest they've been in like a year or two. That's always nice to see. I think here in 2026, hopefully we're going to see some fives. That'll really help the market. It'll help everybody. Now, a big difference between buyers back then and buyers today, and again, other than pricing and interest rate, that I want to look at, right? So now I'm just going to use $300,000 as an average home. This is something that we tell people, hey, should I rent? Should I buy? There's something you need to consider, right? And again, I'm a real estate agent. I don't make money unless you buy or sell. But I like telling the truth because I think good karma comes back around, and this is the truth. Buying right now is not for everybody. You need to be financially stable to buy a house. If you're not, I probably don't recommend buying a house. And one of this reason I'm about to explain is one of the main reasons. If you would have bought at a 2.5% interest rate, a $300,000 house, your monthly mortgage payment, this is no money down, right? So no down payment, would have been somewhere around $1,600. With interest, and I'm not going to get on to it, but that's your insurance, that's your taxes, that's your principal, and that's your interest. Your principal would have been about $500. So nearly 33%-ish, right? And these are kind of just some ballpark numbers of your monthly payment was going towards your principal. So you're actually paying the loan down. So in a way, it's you putting money back in your own pocket, except the bank's kind of holding it as far as your equity goes. So $1,600 was your payment. $500 of that $1,600 was going towards your principal, paying the loan down. Fantastic. That's what we all want to do. Today, if you bought a $300,000 house today, let's say your interest rate was 6.5%, your monthly payment would be about $2,300, so about $700 more a month than what it would have been if you would have basically bought, 21 when rates were that low. Now, your principal, this is where I'm getting into the weeds now. The principal would have been around like $230, $240 a month. So that's about 10%. So only 10% of your monthly payment was going towards your principal. The rest going towards interest, right? Somebody else making money off of loaning you that money. So take a look at that. The difference between a 2.5 and a 6.5 is you as a homeowner, you're getting about $3,000 more in towards your principal per year if your rate was at 2.5 versus the 6.5 today. That is awesome. So your principal at 2.5, you're getting about $6,000 a year towards your principal. And if your interest rate's at 6.5, you're only getting like $3,000, a little bit less than $3,000 a year towards your principal. So less than half. And that's a scary thing when you think about people that are living paycheck to paycheck, maybe only have a couple months saved up. What happens if your water heater goes out? What if your HVAC goes out? What happens if you have a weird thing happen and you signed up for cheap insurance and your insurance don't cover it, right? What happens if your car dies and you got to buy a new car, right? These are all things, and again, you're responsible versus renting. Guess what? We're a landlord. We have 19 rentals every week. I'm doing something that costs me between like $200 and $1,500 on one of these rentals for whatever reason, because something breaks or goes down. I've replaced several HVAC units. We've replaced roofs, water heaters, all that stuff I'm responsible for. So these are just things along with, again, where the economy, people are making more money, but as far as your average household, right, is not keeping up with inflation. So I don't have a solution for that by any means, but I wanted to kind of discuss why. I think you're only going to see this continue to increase. One of the things that I did whenever I bought this house or the house I'm in now, right? My first house, 2017, was I rented rooms to roommates. Rented rooms to roommates. Me and my wife, our monthly mortgage payment, basically between the two of us, was like $250 a piece. And then I had two buddies rent rooms. We were charging them like $500 a piece. Again, beautiful, nice house. They couldn't get anything any cheaper at all, but it made sense to house hack. I encourage you, right? Either if you're a first-time buyer or you're a buyer, house hack. Oh my gosh. Like if you're thinking about buying a house, just rent a room, 2 or 3, let them pay your mortgage. This is something that not enough people do. If you're going to be in an apartment, a lot of times you got a roommate anyways. Suck it up, right? I realize I'm not saying don't get a roommate, don't get a bad roommate. But if you get a good roommate, it's fine. You got to work the system, right? We did that. And it helped us financially get out of debt, pay everything off, and no debt other than the house payment. So yeah, just wanted to share that little tidbit of like a little hack, what I think people can do, and how they can get into a home maybe a little quicker, but also help them financially. So as always, if you have questions, feel free to holler.